Hi, I'd like to talk about some tools that you can use to complete a relative valuation. Relative valuation is generally the same thing as a peer valuation or a comparable valuation. Unfortunately, these things go by different names, but relative valuation is the term used in the investment valuation textbook by DeModern. We have a template in Capital IQ that provides very detailed information about comparable firms. And I'd like to talk to you about how to use this. One of the issues that you're going to face when you try and implement a relative valuation is you've got to identify comparable companies, and you've got to download financial information about the company you're trying to value as well as the comparable companies. This template from Capital IQ will help you do this. So you can see I've got Excel loaded. I've installed the Capital IQ plugin, and so that allows me to pull down this drop-down menu here by clicking on Capital IQ at the top. It has an option associated with templates here. I clicked on that. I'm going to go to Equity Comparables, and here is the Detailed Comps template. Right now it's loading in the template and it's downloading information on Capital IQ. It's got a default ticker already plugged in, and that default is IBM. Let me make it a little larger after it finishes downloading so we can see these numbers a little better. It's a lot of information that's just downloaded. Okay, so I'm going to go to the top. The first thing to realize is that the cells that are in blue are user inputs. These are things that you want to look at changing. The information that Capital IQ downloads is going to be shown in green, and the headings on the template are shown typically in black. Cell E7 is the most important. Assume that we're trying to value IBM, and you'll want to be valuing a different company, of course. All you have to do is enter in the ticker symbol like I'm doing right now and press enter, and Capital IQ is going to go out to the web, pull companies that they think are comparable companies. Capital IQ has selected these companies as possible comparable companies for the relative valuation. It's got Hewlett-Packard, EMC, Microsoft, NetApp, Teradata, Fujitsu, Accenture, and so forth. It's up to you to decide whether these are the best comparables to use to value IBM. What you're trying to do is find firms of similar risk, similar cash flows, similar growth prospects. You also want to have a bias towards finding firms in the same business. Hewlett-Packard makes a lot of computers. They make a lot of hardware. IBM is much less of a hardware firm these days. But with that said, there's no perfect comparable to IBM. Because Hewlett-Packard is expanding more in services and getting more reoccurring software by expanding into long-term contracts like IBM, I would keep HP. So in row 5, you can see that it's asking you the question, include in the analysis, yes or no. What you can do is go to this one for HP, which is in column G, and you can select yes to include it. It's already there. EMC is a comparable company. Microsoft is in software. IBM does a little software. NetApp, I think, is of different size, different growth prospects. I'm going to choose not to include that. There are a couple of others that I would like to exclude from the analysis. Fujitsu is not that similar. Accenture is in consulting. I'll leave this one. I'm going to exclude this final firm from the analysis. So I'm left with 4. I'm left with Hewlett-Packard, EMC, Microsoft, and Accenture. Those are the 4 companies that I've decided are comparable companies. Now, you're going to have to research the operations of these companies, the segments they operate in, the geographical locations, where they're expanding. There are a lot of things you need to take into account to determine whether it's the right comparable or not. I prefer to choose about 3 to 5 comparable companies, and these are the ones that I've chosen. So what you can see is that it's got different tabs down here at the bottom. I'm going to click on Subject, and Capital IQ has already downloaded a lot of information about IBM. There's a lot of information already about Hewlett-Packard, EMC, Microsoft, NetApp. It's got them all here. It's also got Accenture down here, and that's company number 8. It's got some other tabs up here in blue. You could choose a different currency. You can choose whether to use the CIQ consensus estimates, or you can actually enter in your own estimates for the next fiscal year, for fiscal year 2 years out, the next calendar year, the next or the calendar year 2 years out. Almost always you'll keep it at the consensus. Almost always you'll keep the US dollar. You could change this to a calendar year, but fiscal year is generally the approach that Wall Street uses in doing this. It also has a choice about conversion, and this has to do with how it converts foreign currency to US dollars. Are you going to use a historical exchange rate, or are you going to use the current exchange rate? Keep it at historical for most purposes. Okay, so now we've basically looked at the cells in blue, made some decisions there based on how we want to analyze this company, and we can scroll down a little bit. It gives you a lot of information here. So I'm going to talk about some of the key things. You'll see this series right here quite a bit. This is the last fiscal year, LFY. LTM is the last 12 months. FY plus 1 is the next fiscal year that will be announced. And FY plus 2 is the fiscal year 2 years out. So you can see the total revenue. It's got this for the target company you're analyzing, IBM, as well as the comparable companies. It's got the enterprise value to total revenue, if you like that ratio for trying to value this company. It's got the EBITDA, the enterprise value to the EBITDA, earnings per share. It's got the PE ratio, revenue growth, EBITDA growth, EBIT margin. It's got an incredible wealth of information here. Let's talk about the ratio that's typically used, and that's the price to earnings ratio. You've got to make a choice here about what period you want to do. Let's imagine that I think IBM is going to grow, so I would like to look at the earnings for the next fiscal year. In other words, this is taking into account the consensus analyst estimates that CIQ has compiled. What do the Wall Street analysts think are going to be the earnings associated with these companies? Well, it's taking the current market price, the P, and dividing it by the analyst expectations for earnings for the next fiscal year. You can see that IBM currently trades at 10.6 times its next fiscal year's earnings. Hewlett-Packard trades at 9.1 times, and so forth. This comparable trades at 14 times, this one 15, and this one 17.9. Now what we're working towards after we've identified a ratio, a time period, we're trying to figure out what is going to be the justified multiple. That is the multiple we're going to apply and assume is the correct multiple in order to value this target company's stock. Got a couple of columns over here that are useful. Column Y is the average. Column AA is going to be the median. You would want to use the average if you want to include information from all of these comparable companies in the computation of that justified multiple. You would use the median if you want to exclude the outliers. Takes the one in the middle. That's what the median is. So again, we're going to use the PE. We're going to use the next fiscal year's earnings. And the other thing that we need to do is change this to no, because it's circular logic to have the company that you're trying to value included in the analysis. You just want to look at the comparables. You're assuming the comparables are priced. So let's go over here to row 72, and we'll assume that we'll get the median associated with this. If we're going to use the median forward price to earnings ratio based on these comparables, we're going to assume that IBM should be valued at 14.8 times the next year's earnings that analysts are expecting. How are we getting that? Well, the median of these four numbers is actually 14.8. And these are the four comparables that we've selected. How is it getting this median? It's excluding the high which is 17.9. It's excluding the low, and it's averaging these two numbers. The average of 14 and 15.5 is going to be 14.75, which rounds up to 14.8. So that's our justified multiple. And if we wanted to apply it to come up with a target price for IBM, we would multiply that times the EPS 1 year out, which we'll have to turn this back to yes to get what that is. So we would multiply 14.8 times analyst expectations for the next fiscal year's earnings for IBM, which is 17.87. Hey, IBM is worth $264 per share based on our logic. There's some other things you can look at too. It's got information here on the companies. I like this particular section right here because it's got information on the financial ratios, particularly the gross margins, the net income margins. Should IBM be trading at a premium relative to these comparables or a discount? You can look at these financial ratios to see whether IBM is doing a better job of generating earnings from their revenue. Are they using assets better? As an example here, the gross margin for IBM is 49%. The gross margin for Hewlett-Packard is 23.5. Of course, IBM should be trading at a much higher multiple, all else equal, because the gross margin is about twice as high as it is for Hewlett-Packard. You can look at these other things in terms of the capital structure to figure out whether you need to have a premium or a discount on that multiple when trying to value IBM. That's just a quick look at the spreadsheet. There's really a lot to uncover. You wouldn't have to use the PE ratio. Another very popular one is enterprise value to EBITDA. But if you had negative earnings, you might want to do something like enterprise value to total revenue. I hope you'll find this spreadsheet pretty useful as a good starting point. It downloads just a wealth of information for you to go through and to develop a relative valuation.